When we talk about on-demand video streaming, the first company that comes to mind will probably be Netflix, followed by Disney, Discovery, so on and so forth. But today, we want to take a look at this much smaller niche video streaming company, Gaia. The company's share price has been trading sideways for the past year. I think there's a few reasons why Gaia's valuation remained depressed despite showing double-digit growth. First, it is a microcap company and has been making losses for years in the past. Second, being in the streaming market, it may be written off from analyst tracking as they may deem the company as being in a very competitive environment. Competing against largest streaming services like Netflix is an uphill battle. However, Gaia's history has been changing pretty dramatically over the years. Its business is very different from what it was 10 years ago. Today, it is focused on providing digital video subscription service and online community catering to a unique member base, which the company defined as the conscious community that it is trying to serve. As for the concern of competition with larger streaming services, understand that Gaia's content library is focused on niche topics rather than mass entertainment programs. The company segregates its catalog into four main categories: yoga, transformation, alternative healing, and seeking truth. Yes, they are not those mainstream content. Some critics are skeptical about some of its programs touching on conspiracy theories, aliens, alternative medicine, and so on and so forth. But I guess this is also the company's competitive advantage, a double-edged sword, in the sense that mainstream video on-demand companies are not so willing to produce content on these topics. Hence, it creates a focus for Gaia's niche audience who are interested in these programs. So, what does the numbers and data show? Let's take a look. Well, the first metric that we look at in such a growth company will definitely be the rate at which it is adding new subscribers and the corresponding revenue growth. In the charts here, you can observe that both the numbers of members and revenues have been growing substantially over the recent years. In fact, they have grown by more than 20% from 2019 to 2020. As Gaia's focus was on driving accelerated member and revenue growth to solidify their content verticals, they have been operating with losses over the past few years. Only until recently, the management had diverted their focus to an accelerated path to free cash flow generation and self-sustaining revenue growth instead. Hence, we are starting to see some shoots of profits for the fiscal year of 2020. Next, we observe that Gaia has been able to maintain its customer acquisition spend, yet still able to increase its subscriber base by greater proportion. As for its revenue per member, it's showing positive signs as well, increasing from the $7 to $8 level. Such a trend may continue as the company continues to promote its $299 premium annual offering that allows members to participate in the live stream events that the company organizes. Another key difference between Gaia and other streaming giants will be its high gross margin. As observed from the chart here, its gross margin has been hovering at above 85%. The reason that the company can achieve such high gross margins is that Gaia's content is much cheaper to produce compared to a high-budget movie. The company can produce a show such as an interview with an expert for minimal cost. In fact, their average cost of production is at only 0.3% that of Netflix. This means that a good part of the revenue can translate to the bottom line once the company achieves more scale and captures greater operating leverage. In fact, we can begin to see such signs materializing from the table here, with its customer acquisition expenses and other operating expenses decreasing as a percentage of revenue over the recent few quarters. Also, Gaia has a relatively small debt of about $6.2 million associated with its long-term mortgage. On the other hand, it has $13.7 million of cash based on the latest second quarter 2021's report. Therefore, with such a healthy balance sheet, the company is well positioned to continue its growth trajectory while capturing profits for its shareholders in the near term. Now, moving on to valuation. If we look at the enterprise values to sales chart, we can see that Gaia's multiple of around 2.5 times is way below that of Curiosity Streams and Netflix, which are at or near double-digit levels. Yes, Curiosity Streams is projected to grow at a higher rate, hence will command a higher multiple. While Netflix is expected to grow at a rate similar to Gaia, Netflix definitely has a stronger network effect with bigger scale and is already showing profitability. Hence, Netflix should trade at higher multiples as well. However, with Gaia trading at such low multiples, it has a better chance to experience multiple expansion. especially as the company is starting to capture its operating leverage and producing free cash flow. In fact, analysts estimate that the company's revenue will grow by about 20% from the previous year to $80.09 million for the full year of 2021, and this is very possible based on the latest second quarter 2021 quarterly revenue and member growth numbers. Anyway, the company is well positioned with the tailwind of a growing video-on-demand industry that is projected to grow at a compounded annual growth rate of 14.8% from now till 2027. Though I think Gaia can grow at a higher rate in the short term. But let's assume that Gaia's revenue continues to grow at just 15% through 2025. Now, given its high gross margin of more than 85%, we can expect a significant amount to translate to the bottom line. But to be conservative, let's assume that the company is able to achieve a net margin of around 15%. This means that projected revenue and earnings will reach about $140 million and $21 million respectively by 2025. Now, assume a modest price to earnings ratio of 20. I will say that this is a pretty conservative multiple for a company growing at double digits. Anyway, this will translate to a market cap of $420 million or a share price target of about $21.60, and this is about 2 times the current share price of around $10. To sum up, I think Gaia presents an investment opportunity for investors who want to grab a share of the growing video-on-demand streaming industry. The company's recent financial results, showing reduction in the cost of acquisition and maintaining its operating expenses while still growing its revenue at double digits, shows that it is beginning to capture its operating leverage. It is also showing early signs of being profitable and generating positive free cash flow. Gaia's name is becoming more recognized, especially with strategic partnerships with major streaming platforms and media groups to reach more consumers. This could partly explain the reason for lower customer acquisition expenses. Of course, there are risks associated with this seemingly attractive investment opportunity. The key one being that institutional investors may avoid this company due to its controversial content catalog. And also, its CEO holds about 80% of the voting rights and 38% of the total shares, hence essentially controlling the direction of the company. However, I think that the downside is low relative to the upside as Gaia continues to grow and potentially experience multiple expansion in its valuation moving forward. Therefore, I'm adding some to my portfolio and will add more if its share price corrects downward. Let me know your thoughts on this and share with us in a comment below, and consider subscribing to the channel if you find what I share with you today is useful. In the meantime, check out the recommended videos here to continue learning so that you can make better decisions. Keep learning, and I'll see you next time.